welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, zeroing in on a mutual fund scheme that best suits your needs is a difficult task. But I'll tell you what's even more difficult. It is to decide whether to exit a mutual fund scheme. So watch today's episode carefully. For today, our team of in-house experts will give you reasons, pointers that should be deciding factors for you to exit a scheme. So stay tuned.
When your investment goes up dramatically, when you have doubled or tripled your money in a brief period of time, and it often happens, that is when investors are, motivated to sell their fund, because that is when they think that they will be able to, lock their profits only if they sell it. Likewise, when investors invest with great expectations, in great hope that they are investing and they will do well, and then it crumbles. And many a times, investors invest very confidently, and soon after that, the market collapses. Remember, 2008, the beginning of 2008 or 2007 was the record year in which investors were pouring money into mutual fund or investing generally in the market. And immediately after that, in the next 5, 6, 7 months, the market went down by 60-70%. So your 100 rupee getting reduced to 30 rupee, and that too very quickly. So that is when investors, think in terms of selling. And both the reasons are not good enough. Both the reasons are not valid. These two situations should not prompt you to sell. The first behavior that you should be very strictly following is that you are prompted to do these things when you are taking a big bet without much of a plan. If you are methodical with your investment, you will not be prompted to do these two things. Selling your mutual fund for the valid reasons are that you have achieved your goal. You wanted to save your money or invest your money, and you wanted to buy your car, and you thought that it will happen in 4 or 5 years, and it has happened in 2.5 years. Take your money out. There can't be a better thing than that. So you achieve your goal, take your money out. If it happens early, fine. The second reason is that you thought that you are choosing a good fund, and in a year or two you realize that you thought it is a good fund, but it is not proving to be one. And if you are not going to, and if you think that it's not a worthwhile investment for the long run, the fund does not turn out to be as good as when you are investing. That's the second reason. The third is that your circumstances change. You invested for the long run, but now you don't have that long run. You need that money in 1.5 years time, or you need that money now. So you can't be into equity. Primarily, these are the three reasons when you should actually sell and take your money off investments or off equity investments. There is one more additional reason when you should actually do a little bit of buying or selling, which is to rebalance. You have chosen that you have retired and you have whatever money, and you want to be 50% into equity, 50% into debt. And now your 50% into equity have become 70%. So that is it. It's time to rebalance. In fact, I would say that have some kind of margin, that you have chosen to have 50% equity, 50% debt, and this 50% crosses 60%, you should sell part of your equity. Bring the balance back to 50-50. That is the way to lock your profits in a methodical way without being completely out of it and not behaving in an erratic way. Rebalancing is a mechanism. When you are many times, you are able to sell high and buy low.
Underperformance is one of the major reasons why many people choose to sell their investment in a particular mutual fund scheme, and there is no harm in it. But then it is very important to ensure that your fund is actually an underperformer, and that too a consistent underperformer. There's a difference between a fund falling and it being an underperformer. So here you must compare its performance with the other funds in the same category. It is quite possible that the value of your investment might have fallen by 10%, but then the other funds might have fallen by 12% or 14%. Here, although the value of your investment in the fund has fallen down, but it is not an underperformer. So if your fund has actually underperformed its peers, then it is time to look at the underlying reason. See what went wrong. Sometimes it is quite possible that the particular style of investing that the fund is following has gone out of favor. For example, right now growth style of investing is underperforming value style of investing. So if that is the case, any fund that follows growth style of investing is bound to underperform. Here, blaming the specific mutual fund scheme would not be fair enough. All investment styles do undergo different phases. They go through a good phase as well as a bad phase. But then you necessarily need not act on it. While comparing the performance, it is very important that you compare the performance of your fund with its peers over a longer period of time. Don't just look at the last 6 months or 1 year performance. Look at over the last 2 to 3 years. Many times it happens that a particular sector or a particular segment of the market goes out of favor. For example, in the year 2019 and 2018, small caps were not doing good enough. So any fund that would have been investing more in small caps would have not performed that well. Likewise, if you look at the performance of 2021, small caps have given extraordinary returns. And therefore, any fund that would have been investing a higher portion of their portfolio to small caps would have given good returns. Besides underperformance, another reason to sell your fund could be a crucial change in the fund itself. For example, the mandate of your fund changes. Let's say you have been investing in a mid-cap fund which invests only in mid-cap stocks, and you chose that fund particularly because of that reason. But now the fund has gone too big and the fund house somehow decides to make it a large cap fund. It changes the mandate of that fund. Now here you have a reason to quit that fund.
So there are some factors that you should be vigilant about, but they not necessarily warrant a sell. For example, change in fund manager. As we all know, fund managers play a very crucial role in the fund's performance. So whenever there is any change on the fund management side, then one should keep a close watch on the fund. Now, for a well-performing fund, a change in the fund manager looks like a big setback, but it's not necessarily so. Because sometimes the fund is able to sustain its performance because of the processes followed. And a lot of times it may so happen that the fund manager moves internally within the AMC. So in that scenario, the reason to worry is even less because you can expect the fund strategy to continue. But if the fund manager leaves the AMC altogether, then it's more of a concern and you should keep a watch. In fact, for some funds, change in the fund manager can change its fortunes in a positive manner. Because when the new fund manager comes in, he brings his own strategy, philosophy, and investing principles, and that can help the fund improve its performance. And we have recently seen this happening in the case of few AMCs where the funds have started doing well after a change in the fund manager. So for investors, the best approach is to wait and watch. But having said that, if the new fund manager brings very significant changes to the fund which don't align with your investing style or risk appetite, then one may consider selling the fund. Another factor that you should be watchful about is change in the AMC ownership. The impact of change in AMC ownership largely depends on who the acquirer is. This transition becomes more complicated if an existing fund house merges its operations or acquires another AMC, because it simply makes the whole thing about investment strategy, processes followed at an AMC level, and even the continuity in the fund management team more complicated. Therefore, in such a scenario, there are high chances that the investment strategy or philosophy of the fund might change. On the other hand, if there is a new player or a new institution who wishes to foray into the mutual fund business by acquiring an existing AMC, then the impact is generally subdued. Usually, the impact of change in the fund manager or in AMC ownership is visible after a few months. So an investor should wait and watch for some time in order to decide whether they should exit a fund or not. While these are not an immediate trigger for you to sell a fund, but you should be watchful.
Well, with that, it's a time to wrap up this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.